Good afternoon, everybody, or good morning, depending on where you're at the globe. Today, we have a special analyst call. This one's going to be about Ethereum, and there's also a special reason why that is, and it's because we launched our new state of crypto. And our new state of crypto is revolving around Ethereum. There's several reasons for that. We had a state of crypto a few years ago around Ethereum, but a lot of things happened. At the same time, as you might know, the ETFs in the US are waiting to be launched. And that's why we thought it's a perfect opportunity to give an update and basically introduce you to the world of Ethereum. What's really important to mention here, we're going through a lot of fundamental and basic concepts. So for people that are a bit more into crypto, it might be not something new. However, by the end of the call, we're also going to delve deeper on some of the new innovations that are happening. The intention here is really, with our newest report, which you can download as well on our website, to provide you a handbook. So if we have any private bankers in the call or any hedge fund, family offices, or asset managers that kind of need a little handbook for their clients to give an introduction to this new crypto asset, then I think our state of crypto is the perfect choice. So today we're just going to start a little bit with the basics. We're just going to show you a sneak peek on what are the topics that we discuss. And at the end, you obviously have the chance to download the report as well. So maybe let's kick off. As you can see, we're really proud of our cover. But Lena, I think just tell us a bit about what about this cover, why it's a city, and let's take it from there.
Thanks, Adrian. Absolutely, with pleasure. Yeah, so our cover created by our beautiful design team. So I'd like to start with a shout out to the design team who have quickly produced this cover as a city. So the reason why we are always happy to explain Ethereum as a city is because Ethereum is an open source blockchain, smart contract platform that grew exponentially from the limitation or the early limitation of Bitcoin's peer-to-peer system. So they grew from that limitation into more complex and more exciting primitives and exciting projects on it. So there are so many bits and pieces in the Ethereum ecosystem and the architecture design that we think a city would be more appropriate to explain or make it clearer. So let me start from the beginning. Ethereum especially grew or became popular thanks to its financial district, which is represented by Decentralized Finance or DeFi. The major players here are MakerDAO, Uniswap, Pendle, Curve Finance, Lido. It has many dexes, but also new primitives that are only unique for Ethereum, and it has also inspired other blockchains to follow suit. And I'm especially talking about staking services, which we will talk about later in this presentation. But later on, a few years after the launch and after the financial district really proved itself, art galleries started showing up. And with that, and that was in 2017, CryptoKitties came up. It was an auction, an NFT auction, and it attracted even more people who are not even here for crypto, they're here for the art. And gamers, of course. But that also attracted many problems, which is mainly congestion. But the silver lining here is that, yes, NFTs invited congestion, but they also invited developers and builders on top of Ethereum who really believed in the Ethereum ecosystem and did not shy away from building on it. So they went ahead and built tram networks that are represented by the scaling solutions like Polygon, and Optimism, and Arbitrum that would just scale solutions, and it actually now became one of Ethereum's most thriving ecosystems. Another thing that is helping Ethereum become what it is right now, and is the main champion of its security, is the grassroots patrolling services represented by the validators. So these are grassroots. Anyone who has an internet connection and some ETH to spare can stake their ETH and they can validate or securely verify transactions, make sure everything is going honestly. And that also invited a plethora of emerging use cases like file storage, applications, tokenization being at the forefront of this innovation, and also media and advertising, all leveraging Ethereum's security and especially its non-censorship nature. In the next slide, we will see how all these come together and how all these are governed. So one basic unique selling point of Ethereum is its smart contracts. But smart contracts have lived on before Ethereum in the late 90s with the first iteration of a crypto asset, BitGold. It was just an experiment. So smart contracts lived on waiting to be commercially used. And Ethereum is the pioneer of that. So smart contracts are basically contracts who are smart. They have self-executing capabilities. It's like a contract that has a built-in enforcement officer, a lawyer, and a cashier as well. So it's instead of having a long form, a billion pages full of jargon and only a lawyer could read it, it's a code-based contract written in if and then conditions, and enforced also by the smart contract. So they don't need to be waiting for an officer or a police officer to enforce a complaint or whatever. So that is mainly the selling point of Ethereum as opposed to Bitcoin. And that's what brings all these bits and pieces together and makes sure that everyone is behaving properly. In the next slide, we will see how much smart contracts have been deployed so far. We have about 60 million smart contracts on Ethereum, and that is, they hold 40% of Ethereum's supply. That is huge, and that also shows you how ETH is being used in building smart contracts. Smart contracts is the backbone of Ethereum's ecosystem and the decentralized application. So without smart contracts, all these dApps, it would be chaos, basically. So they're just like a self-executing governance system. But however, like any emerging technology that comes up, they have some vulnerabilities that it's all code-based. So there could be a code, there could be a bug, hacking attempts. And this has also been addressed and universally talked about to mitigate such risks. We will delve deeper in this issue, but we have seen some smart contract exploits back in the time. But now I think as the network grew and matures, collecting more validators, more developers, it has been a rare phenomenon.
Absolutely. I think what's really important here, initially it was really an evolution from Bitcoin being just a peer-to-peer monetary network, while here with smart contracts, we're enabling a lot of new use cases, and all of those agreements do live on this immutable, decentralized ledger, and that makes it so unique. So next, why is that important? Why are smart contracts important, and how are they being used?
So let's take a step back. And I know it's difficult in the modern era to imagine it, but imagine a digital world where you're in control of your data. You can interact directly with others, and you essentially bypass the drawbacks of traditional internet models and centralized apps. So that's really the vision behind Ethereum and this kind of decentralized global app store that we have. So as Lena mentioned, smart contracts are what power these dApps. The dApps themselves are just essentially some programmable storefronts which allow users to interact with multiple different functionalities. Often these dApps combine many smart contracts, but this essentially allows for the creation of complex apps like social networks or prediction markets, as we can see in the chart there. The stark difference, or the stark contrast with traditional businesses, is that here, any past transaction or any current users, they're all recorded, and you can have kind of a real-time and complete audibility, which is very different to traditional businesses, which report performance more on a quarterly basis. The key benefit of these dApps is the level of accessibility that they have. For instance, in the DeFi space, these dApps are far more accessible than the traditional financial systems we have in place nowadays. They allow anyone with an internet connection to access Ethereum financial services. To just compare to the traditional world, around 24% of the global adult population, or approximately 1.5 billion people, remain unbanked. and this is due to strict KYC requirements or geographical restrictions, but Ethereum tends to bypass that. So just to pinpoint a couple of the main players in the space, we have lending and other protocols like Uniswap and Aave, which offer services like peer-to-peer trading, lending, and borrowing, and abstract away these restrictions that traditional systems still have in place. But the Ethereum App Store goes far beyond just financial applications. One of the most renowned use cases, which Lena mentioned in the introduction, is the digital art ecosystem powered by NFTs. NFTs essentially act as an ownership for unique digital assets, and it's helping creators monetize their work. So historically, the challenge for monetizing digital art has been the fungibility and lack of clear ownership, right? Anybody can make copies of digital images that you post online. With Ethereum and the ERC 721 token standard, we address this issue and I assign a unique identifier to each artwork, which creates a kind of proof of ownership. The benefit here for artists is that they can generate revenue much more easier by bypassing traditional galleries, which take massive commissions, often up to 60%. I know this because my uncle is an artist, and he is, unfortunately, these art galleries get in the way of his success as well at times. So artists can, in this case, sell directly to collectors through NFT marketplaces like OpenSea or Blur, which would take significantly smaller cuts. Just to pinpoint some numbers here, in 2024 alone, these platforms saw a collective volume of $470 million with 300,000 transactions. So the impact of NFT technology on the art industry is undeniable. Just to take a little shot back in time, prominent auction houses like Sotheby's and Christie's even partnered with artists like Pack and Beeple, who sold NFT-related artwork for $17 million and $16 million respectively. So the potential of NFT technology to transform the art industry is huge. And this could be taken even further and used in other industries, for example, verifying event tickets or using in-game items to allow players to truly own and monetize their gaming experience. And this goes across the whole decentralized app store of Ethereum. For many global brands and across various industries have already started using these Ethereum dApps. For example, Nike, Starbucks, and BlackRock have started to be attracted by the innovation and the potential of this decentralized technology.
I think just to add here, it shows again that we describe it as an app store. So just like the internet was back in the old days, the internet is a protocol, and the internet itself was like the playground for a lot of businesses and developers to build new use cases and come up with new business models. So everything we use today, from Spotify, Uber, Facebook, Instagram, it's all because of the internet protocol. And now with Ethereum, we see a similar thing happening. Again, Ethereum is really this playground of Web 3.0 that gives birth to a lot of new products and services that we might not even think about now. We see the early innings here, but there's so much more potential with these smart contract platforms. Maybe what's really important, I think now we understand, okay, Ethereum, we describe it as a city, or here we describe it as a global app store. So it acts as a base for a lot of innovation. But a lot of people always struggle to understand, okay, I understand the Ethereum network, I understand it's an app store. Why do we actually need a crypto asset like ETH? Why do we need a crypto asset? Maybe Max, what do you think?
Yeah, no, for sure. It's clear that in this case, Ethereum is not just about transferring money peer-to-peer like Bitcoin was. It's really a hub for innovation, which houses various businesses and dApps. And in this case, any transaction performed on these applications is paid for in ETH, is paid for in gas, which means that these fees contribute to the network's value as they rely on ETH for transactions. Not only that, but ETH is used across various venues. We just went over them before, but it can be used for blockchain-based gaming, content creation, and much more. It's really the fuel that powers the entire ecosystem. This kind of utility kind of mirrors or even surpasses that of the US dollar, which I think is predominantly used for FX transactions, or if you're in the US, for buying coffee in the mornings. Ethereum is not limited to these simple payment purposes. The native currency of Ethereum has utility extending beyond accessing these simple transactions.
Yeah, that's really good. If you're in the normal economy, if you're in San Francisco, for instance, you want to buy a coffee, obviously you use the US dollar. While in this digital economy here, you do use everything, every service, every product you use, you have to pay with the crypto native asset ETH. But at the same time, it keeps the city running, right? So it's the fuel for all the vehicles in the city. It's electricity to keep the lights on. So that's why, obviously, we describe Ethereum as that commodity, digital economy commodity that keeps that ecosystem running. But you said there's more to it. Like, what else is ETH being used for?
Yeah, no, of course. So we understand obviously how it's being used, but it's really important to understand that the value of the native asset extends beyond being used for transactions. And in fact, these transactions themselves, they actually accrue value for the network in several ways due to the way that the fees are processed by the network, which is much different to Bitcoin, which has a kind of fixed monetary policy. So just to take a step back, fees in Ethereum are composed of two different portions. There's the base fee and the priority fee. So the base fee is set by the network to ensure smooth operation, and obviously this increases during network congestion to discourage spam transactions and incentivize the quick processing. That being said, this base fee actually gets burned when it's processed. So it essentially is removed from the economy and kind of acts like a deflationary tool, as we can see in the graph there. So what this means is the more activity there is on Ethereum, the more gas fees we accrue, and therefore the more ETH is burned from the economy, which essentially benefits all Ethereum users. On the other hand, though, we also have the priority fees essentially act like a tip to the network's validators, which they receive in the form of staking yield, which we'll talk more about later. Offering this higher priority fee essentially encourages validators to process transactions more, and these fees obviously accrue value for the validators themselves to maintain the security and the efficiency of the network. And actually, it's this very function that is really crucial for challenging the kind of outdated argument that is that blockchain technology can function without a token. So I'd like to say that a blockchain without an asset cannot scale effectively. So the need for a token really comes from the fact that ETH and Ethereum, it should be a public resource that is accessible to anyone that can contribute to the network security as well. So this is the concept that transforms Ethereum into a public utility and a global settlement layer away from centralized coercion. So without a token, Ethereum would just be another database, another private database, sorry, that's managed by different companies, and it misses the full potential of blockchain technology. This native token, it allows global participation and ensures that anybody that can hold and stake ETH can audit and check that the transactions are being processed in a correct manner. So it means that it's no longer going to be controlled by corporations who have vested interests. It kind of functions like more of a versatile stock that offers yield accrual and more. We can liken this to an Apple stock, which directly contributes to the company's security, building applications on the operating system with transparent votes on upgrades and other things. That's the equivalent of the Ethereum economy, if the Apple stock could directly contribute to the company's security.
I love that. I hate that misconception as well. I hate that argument that people believe in the blockchain, but not in crypto assets. And I think you said it, you hit it on the nail. A crypto asset is so important because it provides the decentralization, and it ensures the neutrality of the network. And this is really important. Now, moving on, I think we talk about gas fees and some of those incentives for validators. I think we quickly have to understand where is the staking yield coming from and what is proof of stake actually. So maybe Kareem, can you quickly explain it?
Absolutely, it would be my pleasure. So with proof of stake, it's really more or less a refined algorithm, improving on Bitcoin's sort of limitations and downside in order to allow people to, rather than contribute their resource in quite an energy intensive manner, it would allow users to put up some kind of an insurance. And that insurance would act as a collateral so that users who are called validators, they validate the security of the network, they ensure the insertion of new transactions, and it also acts as a deterrent to them. So that if they act in any kind of a dishonest manner, this collateral or this insurance that they put up front would be taken away. So it's essentially a way to keep them in check. However, what's a bit cooler about proof of stake, which is something that we don't really talk about, is how proof of stake switches or transforms Ethereum. Because as we've just discussed, Ethereum is the digital oil, or ETH is the digital oil. It's the equivalent of the US dollar that is facilitating accessibility to a wide range of goods and services. However, when you add the staking yield on top of it, that transforms ETH from just being a digital oil to allowing this new landscape of having the first internet digital bond. Because Ethereum is a public network, at the end of the day, much like the US government is a public entity, you do need a way to ensure that you are able to keep funding this entity. And that's exactly what staking does. You're allowing validators to contribute to this public resource while at the same time allowing them to earn the digital and native token of this resource. This ensures that there's a positive feedback loop and that there's not a mismatch between the interests of the people backing the network versus the one using it. So it's a really novel way, and I think that really gets overshadowed sometimes.
What do you think is the difference between proof of stake and proof of work? What are some of the advantages and disadvantages?
Proof of work is quite a novel mechanism. I don't think it should be. I don't think it's one versus the other, to be very honest. I think there are two different ways of going about solving a specific problem. I think with proof of work, it serves a multitude of purposes in the sense that if you need the highest security possible, proof of work does allow that, and it actually does that in a very environmental way. But one of the cool ways that you can use proof of work is that you're able to use stranded gas. You're able to use energy that goes into waste, recycling it, and then using it as electricity to as a power source to mine new units of Bitcoin. So that's one thing. But then do we really need that for all types of different networks and use cases? I don't think so. But that is the beauty of crypto and blockchain, the diversity of approaches and the diversity of infrastructures. Whereas with Ethereum's proof of stake, it's more so a way to allow more people to actually contribute to the security because you don't need to be powering up your machines 24/7. All really what you need to do is to have a certain amount of ETH to put up as a collateral, and then you contribute to the security of the network. The last thing I think that most people don't really know about is what this yield is made of. So when we say staking yield, it's really made up of two essential components. It's the consensus layer rewards and the execution layer rewards. When the consensus layer rewards, this comes from token issuance. So the new units of ETH that is coming into the market. This is designed to be predictable because at the end of the day, the most basic function of any blockchain is reaching consensus. So when the consensus layer rewards, this essentially allows the backers of the network to have a very predictable and expected yield that will emanate, and then this allows them to act in a predictable manner, for lack of better words. Whereas with execution layer rewards, this is essentially made up of two components. It's either priority fees or it's MEV. So with priority fees, because Ethereum has an auction model where we're essentially entering into a bidding war where each user can pay a validator a higher amount of fees in order to include his transactions. So with priority fees, that essentially means that this is a way to incentivize or to prioritize the insertion of your transaction into the network. So that's the first component. And then the second component, which I think we can dedicate an entire session for, that's called MEV, maximal extractable value. So this essentially refers to how validators are able to reorganize or strategically insert certain transactions before the other in order to extract the most value out of it. And in traditional finance, this would be called, where it would be looked at as market manipulation, since it includes things like front running and back running. But again, that's a whole other segment or a whole other analyst call that we can get into this. But it's also why we have the report, which we urge everyone to look into in order to have a more in-depth understanding of it.
It's like a bouncer in front of a club, right? Let's say there's a bunch of people waiting in a queue and he orders them by the amount of tip or bribe he would receive from them. That's kind of like
analogy.
how MEV works. Exactly. So now there's even more to staking. I know staking is actually a topic we could discuss for an entire analyst call and maybe even for a state of crypto, but there's more innovation when it comes to staking. Kareem?
Absolutely. So the staking or traditional staking, it has a bunch of limitations, being that you need to lock your token away. Like you can't lock your ETH and then use it at the same time. You have to wait. You have to wait for what we call an exit queue, which is essentially a way to prevent a capital run on the network. So rather than having to abide by this, or that's one of the main core issues. Another issue is that, again, with traditional staking, you need to lock up 32 ETH. That was the main requirement when the merge of Ethereum happened. And then the third thing is that you need to maintain a little bit of a personal infrastructure. You can't, of course, you can just keep the software running, but it requires that you have a little bit of oversight. So all of that was cool, but it wasn't the way forward to allow more people to democratize accessibility to staking. That's why liquid staking emerged. So liquid staking, and there's even another point on that. So the merge happened at the end of 2020. This essentially meant that users were able to lock their ETH, but they were not able to withdraw it. And they were not able to withdraw it actually for the next 2.5 years, even though at the time it was not known when will the next upgrade that will allow people to withdraw their ETH was going to happen. Of course, that wasn't very capital efficient, and it wasn't very encouraging for people who wanted to have access to their capital. So with liquid staking, it was a novel solution that allows users to lock their ETH in a smart contract and then receive back this IOU, or a receipt token. A very simple way to think about this is when you go to your ATM, when you withdraw some of your money, you see your digital balance on the screen. This is not actually your money. This is just a digital number that you see on the screen that reflects the claim that you have, that essentially the bank is holding the money as it is supposed to. That's what liquid staking tokens are. You essentially have a receipt token that represents the principal amount that you deposited or that you invested, plus the staking yield that you accrue on a daily basis. So with liquid staking, people were able to participate in the staking yield. They were able to earn that amount on a daily basis, but at the same time, they were able to use that receipt token across DeFi. So they were able to use the receipt token as a collateral in money market protocols in order to borrow some money against that amount effectively. And most importantly, liquid staking reduced the barrier to investment, because it essentially meant that anyone can invest any kind of an amount that they can deposit into the smart contract, and then they will just earn the proportionate yield amount. So that made it so much easier. And finally, the infrastructure, because you were delegating your ETH to another validator under Lido, for instance. Lido is one of the pioneering protocols. This essentially meant that you as a user, this became a one-click application. You just deposit your ETH and you forget about it. If you don't want to participate in DeFi, so be it. It really simplified access to staking. But there's more. There's more than liquid staking. Liquid staking addressed the limitations of traditional staking, but then we had another new innovative protocol that came out about last year. Yeah, just the last thing that I forgot to mention in the last slide, perhaps, was liquid staking makes up about 45% of all staked ETH, which shows the sheer impact that liquid staking tokens have on the market. That's just a really cool thing to observe and to appreciate. So the second wave of innovation on staking was restaking. So with liquid staking, we addressed the limitations. With restaking, we took Ethereum staking to the next level. So what do I mean by that? Ethereum is a proof of stake network. However, it's not the only proof of stake network. In fact, about more than 95% of the entire crypto economy is made up of proof of stake networks. For each and every one that's about to launch from the ground up, they need to pool a lot of resources in terms of capital, in terms of validators, which are the backbone of any proof of stake network. That's quite a lot to expect from a network that is just coming to life. So with restaking, it allowed this new cool and unique mechanism where, because of the fact that Ethereum has more than $100 billion worth of ETH backing its security, it effectively becomes the second most secured settlement layer after Bitcoin. So in that regard, if you are able to borrow from the security guarantees of Ethereum in order to secure other networks, then in that regard, you create a very interconnected blockchain ecosystem. And that's effectively what restaking symbolized and the protocol called EigenLayer does. We have an entire analyst call. Actually, we're half of an analyst call dedicated to this. So we will send it out in the follow-up to this session. But if I were to just sum it down to two things, it's a very lucrative and it's a very innovative protocol. It has its benefits. Its benefits are with Ethereum staking or vanilla staking, you have somewhere from 3 to 4% in APY. Whereas with restaking, you're able to take this a couple more percentage upwards. So the fact is you're securing the network, you're securing Ethereum, but in addition to that, you're securing another network, which means that you're able to add both sources of yield. So that's what makes it quite interesting. In that regard, it also reinforces a positive feedback loop in Ethereum security, because if it is allowing users to contribute to Ethereum security because they're earning quite a lucrative percentage in yield, then it essentially means that the security of Ethereum is becoming stronger and it's stronger day in and day out. And then finally, you're able to create a more resilient ecosystem, because at the end of the day, if you have a network that is just emerged and it's reliant on Ethereum security, then it becomes a lot harder in terms of targeting the network or attacking the network, because of the fact that you need to have more than $50 billion worth of ETH or $50 billion worth of security in order to perpetrate what's known as a 51% security attack. Its risks on the other side, because of what I just said, you could potentially at some point in the future have so many networks reliant on Ethereum security. So this creates a dilemma of a single point of failure. Another point is the fact that you as a user, you are not only just exposed to the slashing risks of Ethereum, but you're exposed also to the slashing risks of the other protocols reliant on it. So that creates amplifies the exposure in terms of risk. And then finally, let's keep it to those two, because the third one, it might get a little bit too technical. So I would again recommend people to watch the other YouTube or the other analyst poll session that we've had.
And read the New State of Crypto, of course. Absolutely. We now talked a lot about the basic concepts. Some of them are old, like the basics, like how smart contracts work, what are decentralized applications, what is staking. We touched some base with new upcoming narratives, just like liquid staking, restaking. But then another one, which is more on the application layer, or a narrative and a trend that is using and leveraging the Ethereum blockchain, is of course tokenization. The banks at the moment, all asset managers, everyone's working with tokenization. It's a massive hype. Now, what does tokenization actually mean? It's any traditional financial instrument, any asset, but instead of using legacy rails, you now trade it and settle it via the blockchain. That's all it is. However, we see a clear trend here as well. The biggest use cases are, of course, stablecoins across all smart contract platforms. I think there's over 180 billion in stablecoins, and stablecoins are tokenized US dollars, for instance. But now we see an emergence of a lot of other asset classes that are being tokenized. And I think the best example are, of course, government securities, especially due to the high interest rates that we've seen over the last couple of years. We see how the blockchain made use of that, and we saw how government securities, especially US treasuries, have been tokenized. And now all those asset managers, they need to choose a smart contract platform. And as we can see here on the chart, Ethereum is still the preferred choice. They could have several reasons. Ethereum has the longest track record. Ethereum is very robust. And while it has its downsides like slower transaction throughput and high cost, it's still the most secure decentralized smart contract platform. And obviously, if you want to trade billions of tokenized US treasuries, you want to use a secure blockchain. And that's just fascinating to see here how this tokenization space is growing. As you can see, we discuss a lot of different topics in our State of Crypto, but because we spend a lot of time in client meetings as well, we want to talk about some of the things that come up over and over again in those conversations. And what I encounter the most is, or the question is, how can you actually value these crypto assets? They always ask, how can you value them? Now, I would say it can be complex. Obviously, not all crypto assets are the same. For instance, Bitcoin doesn't provide any yield, and therefore you have to use a relative valuation approach. However, and a lot of people don't know that, for something like Ethereum, it's actually possible to use an intrinsic approach, like a fundamental or like a discounted cash flow model. So what we did in our State of Crypto is using a traditional discounted cash flow model and apply it to the Ethereum blockchain. So how does it work? I'm quickly going to run you through. How we approach this is that, first of all, because we have a staking yield, this staking yield can be used as a proxy for future cash flows. And as Kareem mentioned and explained earlier, those cash flows, they consist of two main parts. First of all, we have the transaction fees that are incurred on the network. And on the other side, we have the tokens that are being issued due to consensus. And if you take those two together, we can calculate the total cash flows. And we can see this, it's completely transparent on the blockchain. Then, secondly, obviously, we need to estimate expected future cash flows, like we do this with traditional equities, for instance. So on the right side, we chose a three-stage model where we had a very aggressive growth at the beginning, a moderate growth midterm, and then in the long term, it's like stabilizing. So we have the first part, the second part, and then obviously one of the most important assumptions and inputs in a DCF is the discount rate. And the discount rate, it's a challenging one because in traditional finance, you use the risk-free rate. Usually they take the 10-year treasury yield. What we did here instead is we took a lower bound and a higher bound discount rate. The lower bound discount rate, we used QQQ, which is basically the NASDAQ ETF. And we chose this because it's a more conservative approach. It's a very high discount rate. And at the same time, it reflects and represents the opportunity costs that you have by investing in Ethereum. And then we also have the higher bound discount rate. Here we used the Fama and French free factor model. So we added a market premium, a size premium, and a value premium. Long story short, if we all take it together, we basically came out with a range that goes from almost 2K to almost 7K for Ethereum, which might sound like a big range, but what we want to showcase here is not necessarily to put the price target on Ethereum. It's really important just to showcase that it is possible to apply a traditional valuation framework. So take it with a grain of salt. anyone, any investment banker out here, any equity analyst, run your own DCF. But what we want to show here that it is possible to put a valuation on this new crypto asset. And that's like the key takeaway for this section. And then lastly, and another big question that comes up a lot with clients is, okay, I understand how Ethereum works. I understand it's a global decentralized app store. I might believe in the underlying. I understand you can value it. How do I allocate to it? Let's assume we have a multi-asset approach. So how should I integrate ETH into my portfolio? Max, what do you think? How should we integrate ETH?
Yeah, no, I'd be happy to lose some words here. Of course, we have many traditional investors, so we thought it'd be quite interesting for you guys to see how Bitcoin and Ethereum can be in a portfolio. So we tested a portfolio of 5% Bitcoin and 1% ETH to a standard growth portfolio representing 60% US equities and 40% US bonds across many rebalancing strategies. And so the reason we think it's possible for both to be part of a single portfolio is that Bitcoin is often considered digital gold and can be classified as a commodity. And Ethereum, as we've mentioned throughout the analyst call, is a platform that fuels innovation and powers the next generation of the internet. So it can closely align more with the technology investments that you guys might be making. So we decided they can definitely both be part of our portfolio. I know that they're part of our own ones. So let's dive right in. So the first thing off the bat is that the inclusion of Bitcoin and Ethereum in this portfolio noticeably improves risk-adjusted returns. So this is across all kind of rebalance frequencies. So annualized returns are improved by around 4 to 6%, regardless of the rebalancing frequency. That being said, though, when adding Bitcoin and Ethereum, rebalancing does play an important role. As you can see, with no rebalance period, the annualized volatility starts to get a little bit out of hand when we compare it to the benchmark. It's about 5% higher. So for our risk-averse investors there, we know that the Sharpe and Sortino ratios are very important. And in this case, these are maximized with the quarterly rebalancing frequency. So it shows that this strategy would provide the most risk-efficient portfolio allocation, as it provides the best cumulative returns in line with having healthy and high Sharpe and Sortino ratios. On top of that, we can see that timing doesn't actually really matter. A lot of investors often argue that timing crypto investments is really important, but in our research, we have found that almost 100% of the time, the strategy exceeds the benchmark in the next year and next 3 years. Stay tuned, because we will provide a full portfolio allocation analysis on our website where you can look at this in more detail. And importantly, it means you're never too late to go ahead and invest in ETH.
That's obviously no financial advice, but
No financial.
what we want to showcase here obviously is we believe the numbers prove like a smaller allocation, especially in the past year, they were able to improve the overall performance of the portfolio. And as I think that's the key takeaway as well, rebalancing is key. And Max, you said it beautifully. Bitcoin and ETH, they work so differently. We have Bitcoin as this emerging store of value, while Ethereum is more a platform for innovation. So we also believe that those two assets should sit in different buckets. But stay tuned for the full analysis, obviously. And that brings us to the end of our beautiful analyst call. Obviously, Ethereum is a massive topic. There's so much to unpack. There's so much happening. And 40 minutes is definitely not enough to convey all the knowledge and deep dives that we have. But obviously, we invite you to download our newest State of Crypto. You just got to scan the QR code here, download the new issue. And in case you have any feedback, anything that you might think has been missing, anything you like, always feel free to reach out to us. But obviously, we hope you enjoy the design of the cover, and everything that's inside the new state of crypto. So yeah, please check it out. Good. And other than that, if you have any questions, I think we have a few more minutes just to answer some questions, concerns, doubts. So feel free to put them in the chat. Maybe let me ask a question. What are some of the threats for Ethereum at the moment? Because obviously, just looking at price performance, it has been quite in the shadows, right? Something like Solana has been outperforming ETH. We also see more focus on Bitcoin. So what do you think are the risks, and where do we see Ethereum over the next 12 months? Kareem?
Absolutely. I would say macro is obviously a risk, but that's not unique to Ethereum. That just applies to the entire asset class. A few months ago, we would have said regulatory uncertainty, but it seems that we are headed more and more towards the other side, specifically with the news of the ETF approval. They haven't been traded yet, but just with the approval. So I would say one of them would be the fragmentation of liquidity. So because of the fact that Ethereum has this expensive landscape of scaling solutions, layer twos, it effectively means the same $100 billion that could have potentially been used just within Ethereum, it's now being distributed across 40 plus networks. And the current architecture of Ethereum, there isn't really a seamless and interconnected way to make sure that this liquidity is flowing again without any kind of interruptions or without needing to go through third-party solutions like bridges. However, this will change in the future. This will change in the future with the growth of interoperability protocols, where people will just not really care about what network they're using because liquidity will be shared quite flawlessly across the infrastructure. But there's also something else that I'm really trying not to talk about, which is Intense. So Intense is a new innovation that essentially means that you as a user, you don't dictate what type of action you want to happen, but you rather just say what that final outcome is. And then this, you essentially ask those validators on the other side to find the best execution route. So this would be a key resolution to solving the fragmentation of liquidity, because you wouldn't be concerned of where the liquidity is. You'll just find the best way to get your desirable action executed. The other thing I would say that it might be a risk for Ethereum is the fact that some of the financial institutions are trying to develop their own private. We had this already a couple of years ago, trying to develop their own private blockchain, private permission blockchain. It makes sense in certain very specific scenarios why they would want to do that. If they want to have their own tokenization initiative, they want to ensure that it remains, that their practices is compliant, that it adheres to all the regulations, and this potentially in the current paradigm that we're dealing with, it might not be very possible on Ethereum. However, that also is changing. We have a lot of token standards that are coming out nowadays that essentially bakes some of this compliance requirements into the tokens itself. So that's not really an issue. But again, we do have something like MasterCard, for instance. MasterCard has developed this sort of Swift alternative called the Regulatory Settlement Network, which is essentially, again, an alternative to Swift to facilitate the transfer of assets and information between some of those private chains. However, why I think this is not a sustainable solution, just relying on private blockchains for tokenization, is the fact that it's the public and open nature of blockchains that is what's really quite innovative about crypto. The fact that you are able to intertwine and combine so many different incompatible assets and so many incompatible assets into the same network.
I agree. Yeah, again, you just have a fragmentation of liquidity and different systems. Again, if a bunch of different companies have permission or private blockchains, I would say. We talked about this a lot. Me personally, I believe in permission blockchains that are connected to a public blockchain, just like Ethereum. And this can come in various ways. It could be a subnet, it could be a token standard, it could be a different approach. But in the end, everything's being settled on Ethereum, in my opinion.
Absolutely. And I do think the future is multi-chain. Like that's just it's not a spoiler. or that's not a prediction, that's more of a spoiler. Crypto is so huge. Like the blockchain industry really is the mother of all industries. There's not going to be an instance in the future where one blockchain network is serving all the different industries and use cases. So this is I'm saying this for the point of sure Solana is absorbing a lot of attention right now. Sure, there might be more innovative protocols that will come out in the next few years that might seem that this is the next competition between Facebook and MySpace. But at the end, you're going to need different ledgers and different infrastructures in order to cover for whether it's insurance, whether it's finance, whether it's gaming, whether it's the metaverse. There's just something for AI. There's going to be a plurality of them, and I don't think we are at any point to know for a fact who's going to stick around and who doesn't. We can eliminate some of them, but we don't know who's going to survive until the end. But for the dominant and for the unparalleled network effects of Ethereum, I don't think this is easy to replicate in any shape or form. And that's something that we need to remember about its operating system.
Awesome. I think we're right on time. So again, feel free to download our new State of Crypto. Use it as a tool. If you have clients, if you have people that are new to crypto, they want to learn about Ethereum, we really tailored our language in order not only for beginner, but also advanced to get some insights into this new asset class, especially Ethereum. With that being said, guys, thank you very much. It's been a pleasure as always. Thank you to the listeners and see you in a month or so. See you at the next analyst call. Until then, thank you and bye-bye.
Bye, guys.
Ciao.